Jobs report coming in much lower than expected at 175,000 jobs for the month versus the 240,000 expected. The unemployment rate ticked higher to 3.9%. The report's giving some on Wall Street hope that rate cuts could come later this year. And joining us now is Torsten Slok from Apollo Global Management. Torsten, you had been saying not to expect any cuts this year. Did this report change your mind?
No, it didn't. So there were two things going on in the report that are very important. For the first thing was that for the first quarter of this year, we have had government hiring of 52,000 on average for the last 3 months. Last month, meaning in April, we only got 6,000. So there was about 45,000 jobs that were probably underestimated in terms of what was actually going on. And the second thing is the seasonal adjustment always puts lower weight on April, meaning that the report probably also underestimated what the actual true employment number is going to be when we get the revisions. So those two things combined argue for that maybe we're not too different from where we've been for the last several months. So if I combine that with what we got earlier this week, the employment cost index was higher than expected, meaning wages were higher than expected. ISM prices paid for manufacturing was higher than expected, meaning wages and now also prices in manufacturing higher. And also in services, you also had prices paid that came out today that was also higher than expected. So our view still is that this economy is still hot and inflation is still a problem, and therefore the Fed will not cut interest rates this year.
I want to go back to summarize some of what you just said. It sounds to me like you're saying that this soft number on the points that matter really isn't as soft as it looks on jobs.
That's exactly right, because one thing that's very critical is that the BLS and the BA, of course, do seasonal adjustment of data throughout the year, partly because of weather and for a number of other reasons. But it just happens to be the case that the seasonal adjustment for April has, for the last several decades, always given numbers that were lower in the initial print that would end up being higher in the final estimate. So that's why the low print here has to be taken with some caution. That's also why rates markets reacted quite differently from equities. Rates markets first showed rates lower, but then rates started rebounding, and we saw yields go up for the rest of the day. Whereas equities were essentially, they also came down a bit, but we're essentially saying immediately, oh, this is Goldilocks. So there was quite a different interpretation with rates investors and bond investors putting more weight on the seasonal adjustment argument, and also this argument about government hiring being significantly weaker here in April relative to what it's been for the first 3 months of the year.
6K versus 45, I think you said. Do you think that's just a one-time blip, or is that just perhaps an overall change in the government trend?
Yeah, this is very important, because if you look at revenues from, meaning tax revenues, and the government collects money, of course, every month, you're still seeing a reasonably steady flow. So there is really no good reason why the government should be slowing hiring dramatically in April relative to the 52,000 that we had on average for the first 3 months of the year. So in that sense, if you still add it up, it doesn't get all the way back up to 240, which was the consensus expectation going into the number, but it still brings you much closer. And therefore, it begins to your first question, John, it begins to ask then the question, well, maybe this was not really a strong sign of a slowdown in the economy, in particular not taken together with the other reports we got on ISM, in particular ISM prices paid, and also on ECI earlier this week. So I would actually argue this is not a good week for the Fed when you think about their story that the economy is about to slow down.
Torsten, if you're right about this, is there going to be other corroborating data in May that's going to suggest, maybe the market shouldn't have read the jobs report that way and should have listened to Torsten and what he said both about the government and the seasonality?
No, you're right. I mean, so, of course, the data that's most important really here continues to be the consumer. And a lot of the anecdotes in this earnings season are still showing the picture of a K-shaped recovery, where the higher income groups continue to still do reasonably well, whereas lower income groups are still under some pressure. So taking that together and waiting here for retail sales coming up, then it does become quite important to your question to monitor, are there signs that the consumer is beginning to slow down? For what it's worth, the Red Book same-store retail sales data, which is weekly, is still showing significant strength in consumer spending. So that means that even on that front, we have not seen that consistent picture with a slowdown in the labor market and the story that in particular the equities are painting today. So if I just take the weekly data, hard data for consumption, and now coming up, we'll get the monthly data, I still think, John, to your question, that the consumer is still just fine. And broadly speaking, this earnings season has also given quite surprisingly to the upside strong earnings data. That also does not paint this picture that the Fed has inflation and the economy under control. So that's why the risks are still that the Fed will stay on hold for the rest of this year. That's our baseline scenario.